Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. Today's video is another in the continuing series of videos where I'm going to look for value in each of the 10 major sectors as reported by Standard & Poor's. This particular video is going to look at energy. And the energy sector is a very interesting sector, and there's a lot of things we can learn from evaluating the energy sector about investing itself and about valuation as well. So let's go ahead and get into the fast graphs and let's look at investing in the energy sector. But before, I want to start by taking a look at the overall market. For those of you who are just tuning into this series, it's important to recognize that we are in a very highly valued market right now. So let's go ahead and look at the S&P 500. This is the SPDR S&P 500 ETF Trust. Now, what I want you to understand here about looking at this and how FastGraphs works is one of the things I kind of briefly said and alluded to was at least that FastGraphs is a great research tool, but can also teach you how to be a better investor. There are two critical lines on this graph that I want you to be aware of. There's the blue line, which is the normal price-earnings ratio over whatever time period I'm drawing. And here I'm going back to the beginning of 2004. All right, so here we've got the growth rate and we've got the PE listed as 18.91. Anywhere the stock price would touch this blue line, it would be trading at that 18.91. The orange line is a 15 PE, which would theoretically be an optimum fair value of with a 6.67% earnings yield, but that would be a 15 PE. So what you're looking at here is historical evidence that shows that over the last couple of decades at least, the market has traded comfortably between this, we'll call it 15, and I can even push this out to a 20, because you can see there are times when the market did trade at a higher PE than the blue line. It's a valuation reference. Now, if I change the time frames, watch what happens to the blue line. The blue line for this time frame, which starts at the beginning of 2012, changed to 19. So the point is, it's not that the numbers have to be perfect. It's just that you're trying to assess when reasonable valuation exists. Now, you can clearly see that coming out of COVID, which is this gray shaded area, that the PE ratio of the S&P got well over 23, and today it's well over 25. These are very, very high valuations. Now, we can say the same thing, by the way, about looking at the Russell 3000 ETF. We got the same situation. Somewhere between 15 and 20 times earnings is normal. The market has like to price this at typically a higher multiple. So a 19.5 multiple would be a reasonable, or we'll call it a 20 PE would be a reasonable PE to pay for this. But once again, we're at 25.7. So we've got a very highly valued market, whether you're looking at the Russell 3000 or the S&P 500. But as I always say, it's a market of stocks, it's not a stock market. So if we look for individual stocks or screen amongst the individual sectors looking for value, you'll find stocks that are fairly valued even in this overheated market. So what I've done here is let's go into the FastGraph screening tool, and I've created screens here, and I'm going to look for the energy income screen and the energy total return screen that I ran. So let's go ahead and go in. Let's start with the energy income screen. All right, the energy income screen, what I did was I wanted to see the credit rating, so I just checked credit rating. I didn't put any minimums there. I put the GIC sector as energy, and I did shares, and I did primary tickers. Okay, I also did dividend yield. I just wanted a positive dividend yield. I wanted a PE ratio that was less than 15. That's where value comes in. That would be below the orange line, if you will. I wanted earnings yield above 6%. This kind of contradicts us. This should be 6.67%. But the point is I'm giving a little latitude to the screen. I wanted an earnings persistency score of greater than 60%. Now, what does that mean? That means that these are stocks that have good earnings most of the time and try to eliminate the cyclicality. Okay, and then on looking for other metrics, if I went into the estimated sector here, I looked for earnings growth that was positive, and then I limited this to the United States. Okay, I didn't include Canada in this. All right, and what I've got here was I got 5 stocks. Okay, that was for income. The dividend yields ranged from 1.98% all the way up to 11.28%. So that was my screen for income. Okay, but I also then did a screen where I screened for total return. Okay, and on the total return screen, I wanted credit ratings above triple B minus. It's again the same energy sector, primary. I wanted a PE again less than 15. I wasn't as concerned about the dividend yield here, so I did nothing on dividends. I was really looking for growth. So when I went into my estimates area, I was looking for, again, positive growth, and then the regions were the United States. And what I got here was 16 stocks. Okay, now Fast Graph tool gave me these 16 stocks, and I can go through these individually right here. I can look at them in the short version where I can look at the last 5 years using Fast Graphs, looking at them in earnings, or I can simply do something that I think is what you should do every time you run a screen, because you're always going to get some garbage in a screen. I would go here and add to the portfolio, okay? And I would create a portfolio, and we would call it energy, and I would list this energy as total return. Now, I've already done this for you, so I just want you to know that once I did that, I'm going to go into my portfolios here, and I'm going to search for energy, and I've got my energy screen with my 16 stocks, so I'm going to go ahead and click. Now, here I've got a portfolio. Now, what I can do with the portfolio, once I've got these stocks in a portfolio, I can create a view. Okay, so I'm going to create a new view here. All right, I'm going to do credit rating. Of course, the sector we know is energy, but I'm going to go ahead and click and I'm going to do subsector as well, so I can get a little more granular. I might want to see what kind of debt they have, so I'll look at long-term debt. I'm not too concerned about price return here, but I do want to see what the dividend yield is, and I want to see what the dividend persistency and the dividend growth is. Again, I want to see what the PE is and what the earnings yield is. Again, this is a portfolio, not a screen. I'm just setting up my columns here. And I'm only using adjusted earnings, but I also might want to look, as I'll explain, I might want to look at EBITDA and EBITDA yield as well. Okay, so now I'm going to create this view, all right, and I'm going to name it energy. I'm going to call it 2 because I've already created an energy screen earlier. So I went ahead here and create. So now I've got energy 2 listed here, and I had energy screen, which I previously did. So I've got my credit ratings, my GIC sector, my subsector. So you can see there's oil and gas transportation, production, services, marketing, oil and gas, integrated oil and gas, exploration, etc. Now I can sort these and put them in where they're all going to be, all the same ones are going to be together. So I've got 1 integrated oil, 2 services, about 5 or 6 production, 3 in marketing, and 4 in transportation. I can look at their long-term debt to capital. I can look at them by dividend yield here. And that's one thing you're going to find when I get into these energy stocks. Income really is usually the answer. This is a very interesting sector, especially with what's been going on with the new Green Deal and all this stuff that's going on about climate and alternative energy sources and so on. So there's a lot been happening in the oil and gas or energy sector. And then I've got my dividend growth score, and I've got my PEs and my earnings yield. So I can evaluate these. Right here, I can look at some of these stocks don't have a great energy persistency score, but some of them, like Enterprise Products, has almost a perfect score. And Exxon has a very high score. And Marathon Petroleum has a very high score, 69. But then the scores get to be about half and half. The growth score, that's persistency. The growth scores are also high. The first 4 here would be EPD, Exxon, Marathon, and Energy Transfer have pretty high growth scores, as does MPLX, and so on. Now, again, I can sync this by growth score, and I can get these high growth scores. Now, when you get above 70%, that's actually a pretty good dividend growth score. So as I go through this portfolio, I'm going to expect to be able to see a pretty decent score. And I've got earnings yields here that are all above 6%, which means I've got good value here. And I've got good value on the price to EBITDAs as well in EBITDA. And I'll talk more about that here in a moment. Now I'm going to put the symbols in alphabetical order here because that's the easiest way for me to go through these and keep track of them. So let's start with ConocoPhillips. Now by looking at the portfolio view, I see it's A-rated, It's an oil and gas exploration. It only has 25% debt to capital, has a 2.7% dividend yield, which is pretty attractive. Dividend persistency score is low, but the growth score is high. Okay, and the valuations are good. So now the hat trick is to always go in to the actual portfolio itself. Now, before I do that, if I go into the screen where I look for the high income, I have two stocks, DKL and HESM, that are not in the screen or in the portfolio that I'm looking at here. I'm going to show you in a minute here that I can add those if I want to. Okay, but let's start going with COP. Let's go through the ones for total return. Okay, now here's the lessons I want to point out. This is energy, and if you notice, when you look at ConocoPhillips, their dividend record is moderately cyclical. There's times where they cut the dividend and paid special dividends and so on, just by looking at the white line. That's the white line on the graph. We see earnings are all over the place. The company's very cyclical, but there are times when earnings exploded here coming out of COVID. Okay, looking at forecasting, I see that the analysts, and there are a lot of analysts following this stock, out to 2025, 26 analysts expect to get about 3.5% growth next year. And then it drops down to 20 analysts think we're going to get double-digit growth. But looking at earnings here, the stock would have a very attractive opportunity right now. Now, if I click on the performance tab, okay, what I learn is that if I go down here and look at performance, it's underperformed the S&P 500. That's the only thing I'm comparing it to here by just a little bit. But keep in mind how cyclical it was. But it actually outperformed it. If this is just capital appreciation, on total return, it actually outperformed the S&P because it paid $16,000 plus in dividends versus $7,000 in the S&P 500. So it generated almost twice the income. If I look at the actual dividend rates, you can see that the dividends per share steadily grew on this company for many years. Then they cut the dividend in 2016 by 65% and so on. So I can see that, but nevertheless, they ended up paying a cumulative amount of dividends in excess to the S&P 500. So going back to the historical chart, it's very tough to invest in this stock as a long-term investor as I am. If you're looking for income, it is a little bit iffy. It does generate a lot of income, but there are times when their earnings went negative where they actually reduced their dividend by a great deal. They went from $2.94 to $1. Okay, I'm seeing all this. This is why fast graphs makes you a better investor. I can see the cyclicality of this company. I can do calculations. I can say, like, what happened from this period? I don't see much going on in the price here. The stock literally made no money from December of 2007 to December of 2020. Okay, for that more than a decade period of time, you literally made no money. You got some dividend income, okay, but your $10,000 original investment, which this calculation is based on, would have shrunk to $6,500. That's almost a 35% decrease in value, okay? But your total annualized rate of return is less than one. It was just 1/100 of 1%, or virtually zero, okay? That was for all those years, but you did get income. Now, again, do you want to invest in a stock like that? Now, more recently, when the thing got reasonably priced, when ConocoPhillips got reasonably priced, the last 4 or 5 years, it's been an incredible investment. But what's more important is you can see why, because earnings exploded. They paid a bunch of dividend income, a special dividend, it looks like in 2022, of probably a couple of dollars over their $3 dividend that they were paying. So timing has a lot to do with what kind of investment is. But if you're going to invest in ConocoPhillips, you need, I think, to know a lot about its history. Okay, the next one I'm going to go into then is HF Sinclair, symbol DINO. All right, and once again, we see this enormous cyclicality. We see a pretty attractive dividend yield, but we see, again, a spotty dividend record where there were rises in dividend and cuts in the dividend. So again, what I'm trying to point out to you is here, as a long-term investor, these stocks are difficult to invest in. From a performance point of view, this stock actually outperformed the S&P 500 on balance over this time frame by a pretty healthy margin. It paid significantly more dividends than the S&P 500 as well. But let's go back here and evaluate that. Once again, there would be times when a stock in the energy sector with all these cyclical earnings generated a very, very low rate of return. Now, you can also run different time frames here with fast graphs and get different information. Here, over this time frame, the performance, it underperformed the S&P 500 by a dramatic amount, but yet it still paid more dividends, I want to point out. So you can do all this analytical work with the fast graph tool here by simply running it through different time frames and just evaluating what you see. Again, this is a very difficult stock to own, in my opinion. The next stock we're going to have here look at is Devon Energy, and once again, we see collapsing earnings for more than almost a couple of decades here. We see the stock price going from a high of like 114 down to under $10 a share. You would have lost 15% of your money annually. The company did pay a dividend all along, and it has had this strong rally coming out of COVID. So if I looked at performance long term, I would find that it dramatically underperformed the market, and it paid almost the same amount of dividend income, just slightly less than the market, interestingly. But my point I'm trying to make here, energy is a tough sector to invest in for the long term. If you time it right, there are times where you can make good money in the energy sector. And again, I'm looking at these specific companies. Now, EOG Resources, oil and gas exploration, very cyclical earnings, a pretty steady dividend growth. The company pays under 3% dividend. Again, we see this surge coming out of COVID for the last 3 or 4 years. So if I shorten this time frame to 7 years, I get a little better picture, maybe even do it for 6 years. I get a little better picture. If I just calculate roughly performance here, it's had over 32% a year. And so if I looked at performance over just the last several years, it dramatically outperformed the S&P 500 during a time when the S&P 500 performed extremely well. And again, dividends were 4.58 thousand versus 635. So we're looking at 4 or 5 times as much dividend income over this period of time. Once again, the oil and gas sector is a very difficult sector to be a long-term investor in. It requires a lot of research and due diligence. Now, we're getting into a master limited partnership here. What I like to look at these, because they're all about the income. Here we got a 6.67% yield. It's an A- stock. You can see the white line, the dividend record is great, but it makes more sense because this is an income vehicle to look at it from an operating cash flow, and I want to see the orange line above the white line, or even the blue line would be the same. I'll just take that off to make this graph look a little clearer. Take the blue line off. So they'd have plenty of income, operating income, to pay their dividend, and you can see their dividend has steadily increased. From a valuation perspective, I like to look at these MLPs looking at EBITDA. And from EBITDA point of view, Enterprise Products looks looks undervalued, let's put it that way. And analysts are expecting a 5.5% growth in EBITDA at a 9 times EBITDA fair value. That would be about a 22% annualized rate of return with a 6.67% dividend yield. If I went and looked at the normal multiple, which has been closer to 7, I still have a chance to make over 9% with a 6% yield, counting total return. So looking at it from a historical point of view, 7 times EBITDA is a pretty good number. But once again, with fast graphs, I can change the time frames and I get different numbers. So if I'm looking at my forecasting here and looking at the normal multiple, I do have a drop down here where I can look at what the normal multiples have been over all these different time frames. And some that were around 7 or 8 times earnings. On the high side, I get over 9 times EBITDA. I said earnings, I meant EBITDA. So 7 times EBITDA or 6.76 times EBITDA might be a reasonable number here to get you to pick here. I can pick one a little higher at 7.68 and run my calculation. I get a double-digit rate of return. So I think the investment potential of Enterprise Products is pretty attractive here at this point. The next stock I'm going to look at is Energy Transfer. And again, earnings don't really tell the story. I want to go ahead and look at operating cash flow because this is all about the dividend, a 7.34% dividend yield. We've got a lot of cash flow covering the dividend. If I look at it from an EBITDA standpoint, once again, I get decent valuation. And you can see how when the valuation got really low here, what a great time to be investing. Now, by the way, after a stock has dropped as much as this one has, The average investor will say, oh, this is a dog. Well, obviously, from March of 2017 down here through November of 2020, the stock lost almost over 60% of its money. But if you'd have bought it low, and the main principle of investing is buy low, sell high, then for the last couple of years, you could have averaged over 40% a year, turned 10,000 into 34,000, picked up 8,000 in dividends, and had 10,000 equal over 42,000 in just a short period of time. So again, investing is all about valuation and all about timing. Diamond Energy, again, these are very tough stocks to forecast. Now, by the way, one thing I haven't looked at, and I should for these companies, you're going to find earnings scorecards are going to be very difficult. These stocks are difficult to forecast. You got to give the analysts a little bit of credit here. The stocks that have these kinds of records are very, very hard to forecast. Halliburton, one of the considered highest quality oil and gas equipment and services, drill bits and things like that. But again, look how cyclical the earnings are. Look how cyclical and volatile the stock prices are. The dividend has been pretty decent, but they did cut the dividend coming out of COVID. Once again, if I look at performance of the stock, and I can do all these features here, I can get out here and look at performance and see that it underperformed the S&P. But again, if I change the time frame, it even underperformed worse. If I look at just the last 11 or the last 9 years, counting some forecasting years. So with fast graphs, I can really learn and evaluate, and I can learn so much. If I'm going to invest in Halliburton with, its great reputation, I got to recognize what kind of company it is and what I can expect going forward. And again, an earnings scorecard that's sketchy at best. On a 2-year forward, they've missed it over 67% of the time. The analysts have been wrong. So it'd be very hard for me to rely on this forecast, considering how inaccurate analysts have been on this stock. Moving on, Marathon Petroleum. Once again, we see the same cyclical picture. We see the best time to buy these things when nobody likes them. Of course, this would have been challenging. You'd have faced a lot of news, obviously, where the stock went from earning $4.94 a share to losing $3.40 a share, then to going back up to $2.45, and then all the way up to $26 a share. And of course, we had a nice run in the stock during this period of time. But once again, if you're looking at the analyst scorecard, you're seeing one that's not necessarily pristine. It's difficult to forecast these stocks. But again, I'm not going to go through all, I'm going to, for sake of brevity here, I just want you to see you're looking at the same kind of picture. Now here we have another master limited partnership with an 8% dividend yield. I prefer looking at these with EBITDA. I get a better picture of, this is earnings before interest, taxes, depreciation, amortization. It's really close to looking at it from a cash flow point of view, which I also like to look at to see dividend coverage and protection. And of course, I haven't mentioned it yet, but I also like to look at free cash flow. And the free cash flow picture is not quite as good as the operating cash flow, but the EBITDA is good. Now, you can also, with fast graphs, look at things like sales. And one of the things I wanted you to understand as I'm doing this is how quickly and easily you can look at all these different metrics, sales, EBITDA, earnings, cash flows, and just very quickly learn more about the companies you're looking at. Marathon Oil, again, earnings all over the place. Earnings have been collapsing since the, let's say, 2.5 and 2.6. They're starting to earn some money again. They're forecast to have a pretty flat earnings going forward. Again, I go down the analyst scorecard. It's horrible. They've missed over half the time the analysts have. So very, very difficult to forecast. And just by looking at this historical picture, how could this not be hard to forecast? Look how erratic the earnings are. Periods of explosive earnings, followed by periods of collapsing earnings, followed by periods of negative earnings, and then explosive earnings. The oil and gas sector is one that I've been having trouble investing in for the last decade or so. And I think you're seeing these are the best value in the sector. Here's NOV Inc., an oil and gas equipment and services again. And you can see how earnings have just really been abysmal, but they're starting to recover a little bit. Very difficult stocks to invest in. Here's another oil and gas exploration company. Look how earnings collapsed over these years and how poorly, I'm just picking spots here, how poorly this have worked for 2 decades, lost most of your money holding this for the long term. If you're going to own these stocks, you got to be trading them. You got to be buying them low and trying to sell them high, which is extremely difficult to do. But once again, if I go into forecasting and I look at the analyst scorecard, They miss quite often. About a third of the time they get it right with a 20% margin of error. But once again, I'm not real sanguine about these companies. And here's Plains All-American, which is another MLP. If I look at it from earnings, it doesn't look so hot. If I look at it from EBITDA, I get a little better picture. I still see the effect that fundamentals or deteriorating fundamentals have on stock price, but also on dividend income, and that's the white line on the graph, if you haven't been following that. And once again, they miss estimates 50% of the time on the 1 year and a third of the time. So if I go into forecasting and look at the misses and beats, it's really difficult. And again, if I want to check performance, how they've performed historically, they've dramatically underperformed the market. So again, don't always just get enticed. We've got a good valuation here. We've got, even if I look at EBITDA, I've got a less than 5 times EBITDA, and they normally trade at 7 times EBITDA. But if I look at it from a standpoint of operating earnings, it's traded at around 14 or 15 times earnings, and earnings, again, have been all over the place. And again, I look at forecasting earnings. I don't see a lot of growth, but I see a very bad earnings scorecard. And analyzing these stocks, so far I've not really seen anything, with the exception of maybe enterprise products, that I'd be really interested in investing in. Valero Energy, again, it's really hard to forecast now performance-wise. This stock has actually outperformed the S&P 500, and it's produced significantly more dividend income. But again, there are times where they cut their dividend. But they've also had tremendous growth of the dividend income. So when you're looking at these kind of companies, it's important to understand the nature of the beast, I like to say. Okay, these companies have their own patterns of operating results that I think investors need to be cognizant of. Exxon, again, as we've gone through this energy crisis, I'll call it, with the oil and gas sector, we've seen very poor earnings. We're seeing a surge in earnings now. The one thing about Exxon, though, if I look at it from a performance point of view, and I am long Exxon, for the income, I want to point out, you can see that it generated significantly more income than the S&P, underperformed it over this time frame. But once again, I can change the time frames and I get totally different pictures. Here it really underperformed the S&P, but once again, it kind of held its own with dividend income. But if I look at the long-term rate of return, the dividend has been very steady and has grown at an average rate of about 7% a year. So Exxon has a place in an income portfolio because of this steady, consistent growth in dividends. But again, it's very tough to own to make any money. A long-term investor buying it when it was cheap like this could be making money today, not a lot of money, but they would have also had to endure all of this. And again, investor psychology tells me that investors have trouble doing that. So this is an overview of the energy and gas sector. If I was going to invest in any of them, and I do, is I'd own enterprise products for the yield and for the steady growth of dividends over the years. And I do think it's fairly valued now. But the rest of them, I think they're shorter-term plays rather than long-term plays. In other words, the energy sector is very, very difficult to find any consistent growth in, especially any consistent growth at fair value. Enterprise Products Partners is about as close as you can get. Anyway, this is Chuck Carnevale. Thanking you for watching this, looking for value in the energy sector. I hope you can see the nature of the beast here. Energy is a very, very tough industry to be a long-term investor in the recent decades. There was a time when that wasn't the case, but that's been the case over the last 20 plus years. So be very careful if you're investing here. Don't just look at the numbers, the dividend, the PE, and so on. Make sure you understand what kind of company it is and what its historical record has been and what you could expect from it going in the future. Do your homework and your due diligence. But anyway, this is my look at the energy sector. I've looked at consumer discretionary, consumer staples, communication services. Now here we've done the energy sector. And I'll be moving on, looking at financials here on my next report. If you like the video, ring the bell, subscribe to our YouTube channel, and take a look at Fast Graphs. Fast Graphs will teach you how to invest in stocks and make you a better investor, as well as being a great tool to help you research the correct stocks to invest in. Thanks for watching, and we'll talk to you again real soon.